Good evening, all the joinees. Hi, this is Ansu. I welcome you all to the NGEN Markets webinar. We'll be beginning shortly. By the time the others join in, let's have a look at today's topic. So today we'll be looking at the way how you can optimize your portfolio in terms of its allocation based on either the returns, the volatility, or the Sharpe ratio. Then this model portfolio that you have created can also be compared with your existing portfolio. We would be having a look at this comparison based on their return performance, their holding analysis, as well as the drawdowns comparison of the two portfolios that we have generated. And finally, we would be looking at the ways of generating an actionable proposal that can be sent across to the clients. And finally, the platform would be open for a Q&A session. You can either unmute yourself and put forward your query, or you can write down in the chat box. So let us begin. So once we log on to the NGEN Markets platform, the Markets tab is the landing tab that you see right here. For our webinar related topic, I would be moving to the portfolio section right here. I would be loading in a portfolio from my portfolio section. I click on run. Right here, we see in the components of my portfolio. As of now, it is an 8-item component of my portfolio, and I change in my start date. Let's say I take it from 5 years ago. And right here, you can see in the performance of your portfolio. Now, if you wish to know the optimum allocation of the components of your portfolio, by either maximizing the return or minimizing the volatility or maximizing the Sharpe ratio. For that purpose, we go right here in this improve section. So from this start date that I have input, that is 15th January 2019, I can see in an optimized model portfolio. So this improve section works on two models, first being the ranking model and next being the value model. So the ranking model follows a concentrated approach wherein a maximum weightage has been provided to a single fund, while the value model follows a much more balanced approach. It distributes the weightage among the components in a much balanced manner. So right here in this improve section, we neither add any new fund or any new component, or we do not remove any of the existing component. We try to allocate the weightage among the components in such a way that you find an optimal allocation for the portfolio. So right here, as of now, my existing portfolio has an equal allocation of 12.50% for all the components. You can see in the annual return of 18% with a volatility of 12% and a Sharpe ratio of 0.93. Now, if a lump sum of 1 lakh rupees was invested in this portfolio for a duration of 5 years, starting from 15th January 2019, the final value that I would have obtained would have been 1,92,000. Now, going towards the ranking model, as I mentioned, it is a concentrated approach. The first column that you see is the rank returns column. Under this, the platform tries to maximize the return. So right here, you see that the returns has been maximized to a total of 24%, which was at 18% had I given in an original allocation of 12.5% each. Now, this 24% has been obtained in such a manner wherein a maximum allocation has been given to a single component that has generated the maximum return. So right here, you see quant small cap has been given an allocation of 36%. That is basically because it has generated the maximum return out of all of these components that form a part of my portfolio. And hence it has gotten in the first rank and the maximum weightage. Now the second rank in that, and by rank, I mean the second position obtained by the component in my portfolio in terms of its return is Kotak small cap. And it has gotten in a weightage of 18%. Why? Because it has generated the second best rank out of this list of component. Now you can say that, of course, it has generated a better return, the best return, but at the same time, the risk has also been increased, wherein my original portfolio had a risk of 12%. The rank return model portfolio has taken in a 15% of risk. Now, this portfolio can be suggested to an aggressive client who is comfortable or who is ready to accept a better return provided there is a higher level of risk. Now we come to the minimum volatility ranking model. Here we have given in consideration to the volatility as a factor. So right here, you see that the volatility is minimum when you compare it to the original volatility, 7% to that of 12%. And under this, a highest weightage has been given to such a component that has the minimum volatility generation in this 5-year duration. So right here, you see 36% has been allocated to Kotak Banking and PSU debt fund. Why? Because it has generated the minimum volatility in the 5-year duration. Of course, this being a debt fund would have the minimum volatility. And in a similar manner, if you see, the least amount of weightage has been given to quant small cap. That basically says that it has generated the best return. But of course, there has been a greater volatility in order to generate this best return. Now, this portfolio can be suggested to a rather conservative client who would be focusing on generating a lower level of risk, irrespective of whether the return generation was greater or lower. Now we come to the value model. The value model follows a much more balanced approach. So right here, you see, so right here, we see that the percentage for quant small cap is 21.83%. That is basically because it has generated the best return. Now here, under this model, we consider the actual underlying return value that has been generated by the components in this portfolio right here. It is similar for the minimum volatility as well as the Sharpe value. We consider the actual underlying values under this model. So for example, right here you see for Kotak Small Cap and Nippon India Growth Fund, the allocation is 17% for Kotak and 16% for Nippon. So just by looking at this, I can say that the returns that these two funds have generated, there is a minimum level of difference in terms of their return generation. And that can be seen right here in this Excel format that I have created. Right here, you see the returns that was generated by the components of my portfolio for the 5-year duration. So you see the return that was generated was by Kotak was 26%, while Nippon was 24%. So there's just a 2% difference in terms of their returns. And that is exactly why a minimum or balanced distribution in terms of weightage has been given to Kotak as well as Nippon. While if you compare in terms of their rank return model, you see there is a difference of 6% in terms of Kotak as well as Nippon. Kotak has gotten an 18%, while Nippon has gotten a total of 12%. Next, you also have an option to save this portfolio and compare this portfolio against your existing portfolio that you currently have. So for example, I save this first portfolio, which can be suggested to an aggressive client. So I just click on this save and I enter in a name. For example, I keep in Alvin maybe aggressive. And I click on create. And this portfolio gets saved in the portfolio section. So right here, you have an option to compare two portfolios. In the portfolio section, I go to this compare two portfolios icon. So right here, you can load in two portfolios. For example, right now, I'll load in a portfolio that I had created. My model portfolio should always be on the right-hand side. So I'll load in my optimized portfolio right here. Aggressive optimized portfolio. And on the left-hand side, I load in my current portfolio, existing portfolio, equally weighted portfolio. So right here, I change in the start date. And I click on go. So you can see that in terms of positions, there has been no changes because this is an optimized model wherein we haven't added any new fund or removed any new fund. And right here, you can see that the maximum position in my existing portfolio was 12.5%. That is because all the components were equally allocated in my portfolio. And in my aggressive model portfolio, the maximum position is a 36%. That is because quant has gotten in the maximum position of 36%. Now you can do in a comparison of these two portfolios. So in this graphical manner, graphical chart basically shows that from 2021, my aggressive model portfolio has outperformed my equally allocated portfolio. And that can be seen right here in terms of the annual return difference. A total of 6.14% difference can be seen in terms of my aggressive model portfolio and my equally allocated portfolio. And that can also be viewed in the cumulative returns tab, a total of 67% difference outperformance by my aggressive model portfolio can be seen right here. But this outperformance or better performance comes in with a higher level of risk that can be seen. My aggressive model portfolio generated a risk of 15%, while my existing equally allocated portfolio had a volatility of 12.07%. But at the same time, you can see the Sharpe ratio for my aggressive portfolio is higher than that of my existing equally allocated portfolio. Now we move on to this graphical representation that also says the same, that my model portfolio has outperformed on an year-on-year calendar year basis. That can be seen right here in the year 2021. My equally allocated portfolio had generated a calendar year return of 31%, while my model portfolio generated a return of 45% in the year 2021. And that can be viewed across the 5 years duration. Next, we move on to the asset allocation tab. Right here, you see that the equity allocation percentage has increased in my aggressive model portfolio because since this is an aggressive portfolio, the debt component in my portfolio has been reduced and the equity component has been clearly increased to 83%. And that can also be seen right here in the average maturity duration, which was 2.4 years in my existing equity allocated portfolio and which reduced to 1.17 years in my aggressive model portfolio. Next is the exposures. You can see in the top equity exposures as well as the top debt exposures. In the equity exposures, you see that Reliance Industries is the topmost equity exposure in both the portfolio, equally allocated as well as the aggressive model portfolio. And right here in the market cap exposure, we see that the small cap exposure was at 20% in my equally allocated portfolio, while in my aggressive portfolio, it increased to 40%, plainly because this was an aggressive portfolio. So the exposure increased to a double from what it was in my original equally allocated portfolio. Next, we move on to the rolling returns tab. This tab shows in for a duration of 130 days and 260 days, which is equivalent to 6 months as well as 1 year. So clear difference can be seen in terms of the average rolling returns, which is at a 17% for my equally allocated portfolio and 24% for my aggressive portfolio. And of course, this comes in with a higher level of risk when you compare it with the existing portfolio, which was at 17% volatility, and my aggressive portfolio had a volatility of 25%. Now, of course, you can put across to your client that although there was a volatility increase, there was also a highest rolling return that was generated by this aggressive portfolio of 80% right here. So you can see 80% plays 58%. So a 38% difference can be highlighted right here. Next is the drawdowns tab. The drawdowns tab mainly shows in the ability of the portfolio to bounce back from any loss that has occurred. So right here, we have highlighted a total of 5 topmost loss that has been experienced by the portfolio. Now, this graphical chart mainly shows the movement of the portfolio. So the white region shows in an up movement, while the gray region shows in a down movement, that is a negative movement in terms of the price. So you can see that in terms of drawdowns, my aggressive portfolio has experienced a greater loss when you compare it to the equally allocated portfolio. Why? Mainly because it is an aggressive portfolio. So of course, the risk-taking capacity would be greater. So right here, you see that a loss of 33% started on 11th February 2020 and it ended on 24th March 2020. And the recovery days mainly says that post the end date, how many days did the portfolio take to recover from this loss? And from this list of top 5 recovery days, you can say that it hasn't taken more than 120 days for this aggressive model portfolio to recover from any of the loss or any of the top 5 laws that it has experienced. Next, all this data can be downloaded in a PDF manner and you can share this across to your client. This is an actionable PDF that can be shared to your client. So I just click on this create PDF option and you can see in two PDF options can be seen. A standard PDF as well as an amount-based PDF can be generated. Firstly, I'll be showing in the standard PDF right here. So all the tabs that were visible in the platform can be seen right here in this PDF as well. And all our PDFs and PPTs would be co-branded. Your company name and logo would appear right here on the left-hand side. So the performance chart can be seen, the YTD for your existing portfolio as well as the aggressive model portfolio that you had created from the improve section can be seen right here. The asset allocation and the equity exposures and the rolling return tab. And next, this final page is the percentage based allocation. So right here, you can see that for your existing portfolio, this was an equally allocated portfolio. So a 12.5% allocation has been given to each component. And your aggressive model portfolio, which you created, which you compared against your existing portfolio, their individual weightage can be seen right here. Now, this was a standard PDF that was generated. Now, an actionable PDF means or amount-based PDF. For example, your client has an AUM of, let's say, 10 lakh rupees invested in that specific portfolio. I click on go and a PDF gets generated. So all the pages, top 3 pages remains the same. The difference comes right here in the final page. Right here, you see that the 10 lakh rupees that I had input in that amount section gets distributed among the components of my portfolio based on the weightage. So you can say that this is the existing allocation in terms of rupees, while this can be the target allocation that you can suggest to your client based on the performance that we had considered. Now, this all data, if you do not wish to see all this data, you have an option to take in screenshot, section specific screenshot. For example, if you just wish to see only the asset allocation, you just click on this screenshot option and just this specific section would get downloaded onto your platform. All right. Just a minute. Right here. A screenshot would be visible for the section that we had just kept our cursor on. Additionally, we can also generate single level portfolio analytics report right here. I just load in a portfolio. A PPT option can be seen right here. I just click on PPT and create PPT. Percentage based PPT would get downloaded. Right here. So these are customizable PPT. You can edit these PPTs and you can insert in maybe any screenshot, the screenshot that we had seen right now. You can insert those screenshots right here in this section. You can edit in these PPTs. You can add in multiple slides. So that is it for the topic related discussion. If there is any query, kindly unmute yourself, or you can also write down in the chat box.
Hello, good evening, ma'am. I'm Anil Chatwal from Chandigarh. Can you hear me? Hello?
Yes,
Hello.
we can hear you.
Can you show how we can improve how we can change manually the funds allocated in the portfolio instead of using your improved tool?
So typically, what you would be doing with the improve option is you would be changing in the allocations, right? If you want to change in or maybe add funds actually in the existing portfolios,
Or
then
even allocation manually.
Okay, so you said you want to manually change the allocations, is it?
Allocations as well as the funds, both.
Okay, got it. So in that case, you will have to typically go to the compare section and actually see which is a better performing fund as compared to the ones that you existingly have. For an example, we were having a look at this particular portfolio, right? You take all the components of this particular portfolio in the compare section by simply clicking on this compare option. All the components get added here. And now let's say we want to choose from one particular category, right? In this case, we have a quant and a Kotak, and let's say we want to add in a couple of other small cap funds to actually replace the small cap funds that are actually there in the portfolio. Let's say for an example case, any small cap fund that you would have in mind, you simply add that and actually compare the performance of that particular fund versus the one that you already have in the portfolio. Once that is done, then you can say that, okay, I would like to go ahead with I just added a a Motilal Oswal small cap fund, right? In this, right? Then you compare this with the other funds and then you see, okay, which is a better performing fund in small cap as a category, and then you change it with that fund. Typically, in the improve section, we do not add any new funds, neither do we delete any funds, right? All we do is arrive at an optimal allocation in such a manner that either aggressive, which is ranking returns, or conservative, which is minimize volatility, that is achieved. That is all we do in the improve section.
Okay, ma'am. If I get ECAS statement of one customer and I upload that statement, and whom I want to suggest to add new funds and delete some funds and the percentage or rupee allocation in the suggested funds. So how that can be done?
Sure. For that, we have a statement analyzer tool that you can see on the platform, right? Right at the top, you see statement analyzer. You click on that. And NSDL, CDSL, or CAMS ECAS statements can be onboarded into the platform, right? Once you add those statements, then the entire, one second, let me quickly show you. I have a test CDSL file. You click on choose file. One second. There's a test CDSL file type. You put in the file password and you click on check file. Once that is done, the file will appear right here on the right hand side. Once it appears here, that means the current holdings of that particular file have been captured. And then you take that entire portfolio for analysis in the portfolios or the client section. Look at that. So we have captured the file of Mr. Deb Kalyan Kumar Mazumdar. We go back to the platform. We go to the client section. We go to the manual data tab. In this case, you choose to add it manually from statement analyzer. One second. You click on this plus icon and all the components of that ECAS will be onboarded onto the platform like this. These are 11 holdings. Latest holdings update is 19th of Jan 2024. That's today, of course. The NAVs will be as of yesterday. And then you click on run analytics. Once you do that, then you simply go to the contribution tab, which is a very helpful tab to actually determine how much return is being contributed by what component in the portfolio. right? So in this case, you simply go here in the contribution tab. And let's say you want to do this analysis for the last 5 years, right? So you choose January 2019, and date could be 18th January 2024, and you click on run. So in this case, you see the best performing fund is the IPRU asset allocator fund, and it has contributed 42% in the portfolio return. However, that is, to a certain extent, because its allocation in the portfolio is also very, very high, close to 40%. However, if the portfolio would have been given a higher allocation to a DSP small cap fund, or for that matter, a IPRO thematic advantage fund, which individual return is 145%. If the allocation to this particular fund would have been increased, then your portfolio allocation would have, or your portfolio return would have definitely increased. And that is what decision making you can do with this contribution analysis.
Yes, okay, ma'am. But whatever rebalancing I do here, how I can do the same in the portfolio also.
Okay, so then meaning you would like to add a new fund that you have researched,
No.
right?
For research, no. Okay, I want to show that I have improved your portfolio. You delete these funds or add these funds. I want to show that to my client.
Right. So then you will require two portfolios side by side, right? One would
Yeah,
be a model portfolio and one would be an
yeah.
existing portfolio. That is
Hmm.
exactly what we showed, previously in the webinar.
Okay.
You compare two portfolios side by side, and let's say, this is, let's say, one portfolio, and instead of actually, optimizing
Okay.
the same portfolio, you load in the model portfolio that you would have researched, right? This is the model portfolio. This is a totally new portfolio, right?
Mm-hmm.
And then you
No,
yes, exactly. And then you typically generate the PDF, which was again an actionable amount based PDF. Let's say the client has
okay.
20 lakh rupees in his as a AUM in his portfolio. You simply put 20 lakh rupees, you click on go. A actionable PDF gets downloaded. Initial 3 pages are going to be the analytics. The final page will act like a proposal. So this is the existing allocation versus this is what I am recommending you to move towards to achieve the excess return that we just saw on the platform.
Okay. Thank
Right?
you.
Like this, you can compare. Okay, so there's another question in the chat box which says, can you demonstrate how to compare two mutual fund schemes and see the overlapping portfolio percentage? Yeah, sure. We can definitely take you through that. You go to the NGEN Markets main page, and you go to the compare section. Because you're speaking about two single funds, let me just remove, other content. So we have Axis Focused Fund, and then maybe we are keeping Kotak and a Quant, both from the small cap category. Right? Let us clear everything else from the compare section. So we have just two funds. You simply go to the position overlaps tab in the compare section itself. Okay. You click on this and you will see the overlaps, common holdings in these two funds. In this case, you see that Quant small cap and Kotak small cap have very less common portfolio positions. If you want to see which are these 2% positions, you simply click on this and you have the details. So Balrampur Chini and a couple of others are the common stocks in both the portfolios to varying degrees, right? 1.11 is by Quant small cap. 1.23% of its portfolio of Kotak small cap funds portfolio is into Balrampur Chini. And the minimum of the two is the overlap, which is 1.11%. This is how you can check overlaps between any pair of funds, right? I have just taken example of two funds. You can take as many funds as you would like. So for an example, let's simply take a list of, let's say, 7 funds, right? So we have these 7 funds from diverse categories. We have one from aggressive hybrid, large caps, flexi cap, dynamic asset allocation, and so on. You simply go to position overlap. This is like a matrix structure. What you can do is hover on this first row item. So now in this entire row, you will see overlap of DSP healthcare fund with all the other funds in the list that you have. So the moment I hover on this, that says with a Aditya Birla Sun Life Flexi Cap, that's a 9% overlap. The moment I go on the next cell on the right hand side, it gives me overlap with HDFC Flexi Cap. And so on and so forth. You go on hovering on. And let's say you want to have a look at DSP equity opportunities and DSP healthcare fund. The overlap between these two, which is highest 10%. You click on this. These are the details. That is how you can check overlaps. Okay, so there's another question in the chat box which says, can we get data on how much investment is done across sectors, or which stocks are held by most MFs in the industry and in all? Sure, we can do that using, there are a couple of ways of doing that. Let me first show on a particular mutual fund level. Let's say you want to run actual holding analysis on a single mutual fund level. What you'd simply do is you click on that particular mutual fund, it gets open in a new tab. For an example, I want to have a look at HDFC FlexiCap Funds holdings. You click on that, it gets open in a new tab. Go to asset allocation, and these are its current holdings. These are as of 31st of December 2023. If you want to see the trend of this particular mutual fund into investing into various sectors as well as stocks, you simply go to the third tab under asset allocation. So asset allocation, overview, position changes by month, and positions over time. You go here. And this is where you get it, number one, by security, which is by stock. And the trend is for the last 12 months, month on month, as well as by sector. Okay, so in this case, you see that in banks as a sector, that's the currently heaviest weighted sector by HDFC FlexiCap Fund. And the allocation of 30.88% of its AUM is into banks as a sector. Okay, this was for a this was for a single mutual fund level. If you want to check this for the industry, by industry, I'm going to show you how you can check it for the entire flexi cap as a category. Then for that, you need to go back to the NGEN Markets platform. You go here in the funds section, and holding analysis is what you should be targeting, right? So default, you will be landing on the screener. You need to simply move on the right hand side, which will take you to the holding analysis tab. The moment you go here, you have to put in flexi cap as a category in check funds with SEBI category, right? In this case, from this drop down, we have equity as a bucket, which are all equity oriented funds. Next, we put in the subcategory. We are looking at flexi cap currently. So I choose flexi cap funds. And now this is the analysis that you can see for all the flexi cap funds trend into investing in different sectors month on month. In this case, I can see the universe, right? Number of funds under consideration is 38 as on 31st of December 2023. That means as on 31st of December 2023, there are 38 flexi cap funds trading into Indian equity markets, right? And the heaviest weighted sector happens to be banks again. You simply click on this and you see the details. What all mutual funds hold in what all percentage into banks as a sector. If you want to check this in amount terms, simply sort this on the basis of highest to lowest amount, or even in percentage terms, highest to lowest percentage. Additionally, if you want to check it, the trend for the last month on month basis. So this is what the color coding is all about, right? So this was in banks as a sector. For an example, you want to check in automobile. You can check that after August, typically in September, there was an increase in allocation into automobile as a sector, and that kept on increasing by all the flexi cap funds till November of 2023. After that, in December, there was some selling off. Basically, it liquidated its position from automobile as a sector, right? So this is the trend that is available for month on month basis on a sector specific level, right? This can also be checked on a stock specific level. You simply go here on stock changes, and this is available on a stock level, right? For an example, in Infosys Limited as a stock, you want to see across all the mutual fund categories in equity as a bucket. You want to see the trend of mutual funds investing in Infosys. You simply locate 31st December 2023. That's, I say 31st December, that's because it's the latest update that we have on the platform, right? Latest holdings update. And then you click on this, you will have the list of mutual funds holding Infosys share. You can sort this on the basis of highest shares, or alternatively on the basis of highest percentage or amount that is possible. Okay, so we have another related question which says, how can we know how much entire MF industry has invested in banks or finance sector overall at an industry level? Okay, so in that case, what you will have to do is you'll have to clear this off, right? That means we are basically broadening our universe. Previously, we were checking only flexi cap as a subcategory. Now we are considering all the subcategories from the equity bucket. So look, these are the 4 buckets that we have. When I say equity bucket, all these subcategories are considered. Value, small cap, large cap, mid cap, large and mid cap, everything which falls into equity as a category, right? You go to holding analysis and you just simply choose this, which is equity as an asset class. And then this tells you across all the equity oriented mutual funds in the mutual fund industry, what are its allocation to banks as a sector. So that's 700 funds under consideration. 21% of all of these 700 funds AUM is invested into banks as a sector. Which are those? You simply click on this and the details are available. So you can sort it on the basis of amount or percentage. Right? So this is how you can do it. There's another question which asks, can we compare the market cap weightages in the list of schemes in flexi cap? Yeah, sure. So by market cap, I think you mean large, mid, and small cap, right? So for that, what you need to do is you go to the compare section, you remove everything, and you load the entire flexi cap as a category in the compare section. So we are in the compare section. You go here, add group, and add the entire flexi cap category here. Right? So we have 38 funds in the flexi cap as a category. You simply click on this. All the 38 flexi cap funds are going to be added here as a component in the compare section. Once they're added, let them get loaded, and then you can simply scroll on the right hand side to actually check their holdings and the split between large, mid, and small. Let me just show it to you. Okay, so now once we have all of these funds, what you need to do is using this, scroller that you can see at the bottom. Use the scroller to hover on the extreme, rather to go on the extreme right hand side, right? Here is where you will get the split between large, mid, and small cap, right? For an example, if you want to check among these flexi cap funds, which is the fund that has, taken exposure into large cap stocks, the highest, that's HDFC flexi cap, it has 78% into large cap stocks. Right? Similarly, you can replicate for any other market cap exposure. If there are any further questions, please let us know. Okay, so there's another question which asks, can we check the duration analytics of CBF? By CBF, I think you mean corporate bond funds. Oh no, can you please clarify what do you mean by CBF? Corporate bond funds, okay. For various schemes, okay. So for that, you go to, fund section, you go to screener. From the filter categories, you choose corporate bond funds. And then you click on close. So you have all the corporate bond funds here. Once they are here, what was your question? Sorry. Analytics of durations, right? So duration details, what you can do is you can simply take them to the compare section. And similarly, as we saw previously, beside that, these are the duration. By analytics, we have the current durations that they have. So that is available on the platform to explore. One second. Again, using the scroller, we'll be moving on the right hand side. These are the durations of across all the funds from the corporate bond fund as a subcategory. Lowest is Bandhan Corporate Bond Fund. And the highest is a Baroda BNP Paribas Corporate Bond Fund with a 3.83 years as a duration. Okay, I think those were all the questions for today. I think, Ansu, if there are no more questions, we can close for today.
All right. Thank you all for joining in for today's webinar. You can visit our YouTube page. You can see in a link right here on the platform. You can see in a dedicated playlist for all the webinars that have been conducted. As of now, a total of 96 videos have been uploaded, and today's video would also get uploaded. You can explore them anytime. Hope to meet you again next time in next week's webinar. Thank you for joining in.